The gears of the global economy are grinding, and the signs of a major reset are becoming impossible to ignore. A market crash isn't a question of if, it's a matter of when. And for most people, that idea feels frightening. But here's the truth: most investors never hear. Crashes don't destroy wealth, they transfer it. Right now, analysts are pointing to everything from inflated asset prices to unsustainable debt levels. The message is the same everywhere. The market is stretched, vulnerable, and primed for a serious correction. And when that correction hits, 99% of people will react the same way they always do, with fear. They will panic, they will sell, and they will lock in losses that take years to recover. But a small group of investors will do the opposite, and they'll come out of the chaos far wealthier than before. This video isn't about predictions. It isn't about complicated jargon. It's about a simple, practical framework anyone can follow to protect their capital and use a downturn to accelerate their wealth. By the end of this video, you won't be afraid of a crash. You'll be ready for it. Let's be clear. The talk of a market crash seems to always be around the corner. While nobody can say for sure when a crash will happen, you'll always hear warnings about everything from a new bubble to concerns that the market is just overvalued and due for a fall. Some analysts might be flagging a small correction of 10 to 20%, while others point to bigger risks on the horizon. This creates a lot of noise and a lot of fear. And for 99% of people, that fear leads to catastrophic mistakes. Their emotions take over. They see red on the screen. They hear panic in the news. And they do exactly what their fear tells them to do. They sell. But for those who understand how wealth is really built, the panic isn't the problem. It's part of the plan. As the famous investor Warren Buffett said, "You should be fearful when others are greedy, and greedy when others are fearful." A market crash is the ultimate test of patience, and it's the peak of fear. That's your signal. To get on the right side of this, you first have to understand the three cardinal sins of a market crash. The critical don'ts you have to avoid. The plan for building wealth in a downturn is less about what you do and more about what you don't do. These are the three traps that cause most people to lose money. Don't number 1, panic sell your investments. This is the most common and most destructive mistake. When the market drops, your portfolio can look like it's bleeding out. The natural instinct is to stop the bleeding by selling everything. This is a fatal error. You have to understand the difference between paper losses and realized losses. When your investments are down, that's a paper loss. It's theoretical. The number on your screen is lower, but you haven't actually lost any money because you still own the exact same number of shares. A loss only becomes real at the exact moment you hit the sell button. Think of it like owning a house. If you bought a house and a year later the market softens and similar houses are selling for less, have you lost money? Not unless you actually sell the house at that lower price. If you just keep living in it, knowing it's a good house, you give it time to recover its value. Selling your stocks in a crash is like running out of your house in a storm and selling it for a lowball offer. History has shown that markets eventually recover after a crash. Selling just locks in your losses and takes you out of the game right before the rebound. Don't number 2, try to time the absolute bottom. The next trap people fall into is trying to be a genius. They think, okay, I won't sell, I'll wait for the market to hit rock bottom, and then I'll invest all my money. This is a fool's errand. Nobody, not the experts on TV, not the brilliant hedge fund managers, can consistently predict the exact bottom. Trying to do so is pure gambling, not investing. And the cost of getting it wrong is staggering. Research consistently shows that the market's best days often happen very close to its worst days. According to Wells Fargo, looking at the 30 years from 1995 to 2025, if you miss just the 30 best days in the market, your average annual return would have dropped from 8.4% down to just 2.1%. Another analysis showed that missing the 10 best days in a 20-year period could cut an investor's total return by more than half. By sitting on the sidelines trying to pinpoint the perfect day, you're far more likely to miss the powerful recovery than you are to time the bottom perfectly. Don't number 3, sit on the sidelines in cash. The third mistake is thinking that cash is safe. During a crash, It feels safe because your bank balance doesn't go down. But this is an illusion. While you're hiding in cash, two silent wealth killers are eating your money away. The first is inflation. Economic turmoil can often involve inflation, which erodes the purchasing power of your cash every single day. A dollar today simply won't buy as much as it did in the past. Cash that isn't working for you is slowly losing its value. The second, as we just discussed, is opportunity cost. Market recoveries can be incredibly fast and happen when no one expects them. After the crash in March 2020, for example, those who sold to cash missed a massive rebound that happened just a few months later. While you wait for certainty, the market recovers without you. Staying in cash is choosing to lose slowly to inflation while risking missing the rapid wealth-building recovery. Now that we know what not to do, let's build the simple, actionable plan for what you should do. This is the core of the strategy, and it doesn't require a finance degree. It just requires discipline. Do number 1, reframe your mindset. The market is on sale. This is the single most important step. You must fundamentally change how you view a market crash. Instead of seeing it as a crisis, you must see it as a sale. A 50% off event for the world's greatest companies. When your favorite store has a massive discount, you don't panic. You get excited, and you rush to buy the things you've always wanted at a fraction of the price. This is exactly what a stock market crash is. The best companies in the world are suddenly available at a huge discount. This brings us back to Buffett's philosophy. When others are fearful, that's your signal to start buying. Do number 2, automate your investing with dollar cost averaging. This is the engine of our simple way to get rich. Dollar cost averaging is the antidote to trying to time the market. Here's what it is. You invest a fixed amount of money at a regular interval, say $500 every single month, no matter what the market is doing. You set it up, and you automate it. Here's why it's so powerful in a crash. When the market is high, your $500 buys fewer shares. But when the market crashes, that same $500 automatically buys more shares at a lower price. Over time, this strategy lowers your average cost per share. You're systematically buying more of an asset when it's cheap. It removes emotion from the equation. Then, when the market eventually recovers, all those extra shares you bought at a discount will power your returns. This is discipline, automated. Now, this doesn't guarantee a profit or protect you from loss, but it's a disciplined approach for the long term. Do number 3, focus on quality and diversification. So, what should you be buying? For a simple, straightforward approach, the answer is buy the whole market. Don't try to pick individual winning stocks. That's a difficult game. Instead, the simple strategy is to buy low-cost, broad market index funds, often as ETFs. Think of it this way. With a single share of an S&P 500 ETF, you are instantly invested in 500 of the largest companies in the US. You get instant diversification. The logic is simple. While any single company can fail, the broad market as a whole has always recovered from every crash in its history and eventually gone on to reach new highs. By betting on a broad index fund, you're not betting on one company's survival. You're betting on the long-term resilience of the entire economy. For most people, this is the most reliable way to invest. So, what is the simple way to use a market crash to get rich? It's not about risky bets. It's about having a fortress of discipline and the right mindset. First, you avoid the 3 great wealth destroyers. You do not panic sell. You do not try to time the bottom. And you do not hide in cash. Then, you execute the simple 3-step plan. Step 1. You reframe your mindset. The crash is not a crisis, it's a sale. Step 2. You automate your plan. You use dollar cost averaging to buy consistently. Step 3. You focus on quality. You buy broad market index funds. That's it. That's the entire roadmap. The difference between losing money and building a fortune isn't complexity. It's having a simple plan and the discipline to stick with it when everyone else is running for the exits. Now, I want to hear from you. What is your biggest fear when it comes to a market crash? Let me know in the comments below. Remember, preparing now is how you win later. And as always, I'm not a financial advisor and this is not financial advice. When investing, your capital is at risk. The value of your investments can go down as well as up. If this breakdown helped you, make sure to like the video, subscribe, and turn on notifications so you never miss what's next. This is Mindcraft, where ideas become action and action becomes your future.